Good evening, everybody. Look, welcome back after a month of quite hectic markets. There's a lot going on. There's all sorts of things going on with the central banks, but also there's an awful lot of focus on growth, and the impact of that on all markets needs to be taken in consideration. So, obviously, with commodities, what I want to do is just look at the moves we've had up until the sort of start of this month, so from January to now. And these are the commodity moves we've seen in 2023 that I think are really important. So obviously with commodities, supply and demand obviously are the key movers in this, as well as the fact that some are also many are priced in dollars, and so the dollars fluctuations also impact commodities. But realistically, the supply and demand dynamics do play a massive role, and that is something we need to keep center of these thoughts. So we have also oil and copper, both real bellwethers of economic growth and demand, if you like. You know, copper usually does well. It's known as Dr. Copper sometimes. If copper's doing well, then manufacturing's probably doing well. The economies are probably growing. Demand is there. And the same for oil, really. And as you can see, at the beginning of the year, if we look at this bottom chart on the left here, we saw this copper rally. Now, this was really sort of based on the fact that China was reopening. There was a great deal of hope that this pent-up demand would see commodities go on. And look at the oil market as well on the right-hand side here, exactly the same sort of thing. So the demand scenario was very strong there. And I think, you know, the market was really beginning to believe that China reopening was going to ride to the rescue of the global economy. However, since mid-April, that hasn't really been the case, and we've had some disappointment in some of the Chinese data. We've had a US regional banking crisis, sort of actually playing against risk appetite, and so anything that was owned became unowned, if you like. And we've seen some quite serious capitulation in some of these commodity areas, and I think that's really quite important. So we've had the lack of demand over fears over lack of growth still coming out of China and other areas, indeed, with recessions expected in the US and possibly the UK. And I think, you know, we have got a certain amount of fretting about a global recession, and that, of course, has hit oil and copper quite hard. And I'm not surprised, because I think many people have got ahead of themselves thinking that we were going to see this big recovery. Interest rates will start coming down as growth sort of stalled a little bit, but in fact we're seeing interest rates stay high and growth still falling. So not good for commodities at the moment, because that higher dollar is also pushing down on commodities some degree as well. So if we look at the oil moves from March into May, sagging oil prices in March were revived only briefly by a surprise OPEC plus production cut. Now, one would ask immediately, why did they cut production? Now, some said it was political. I really didn't buy that at all. For me, I think they could see quite clearly, as I was looking at, that there was a potential slowdown coming. And, you know, to be honest, they've been proved absolutely right. So we have seen this, you know, after this surge in prices, you can see on the chart here, as the cut was announced, it pretty quickly fizzled out. And again, this was poor data out of China, PMIs. We actually had some data on Sunday as well, which was also looking that China and imports had fallen very, very steeply, which means that economy is not as strong as we expected. And so this oil move has come off on a demand structure, almost a capitulation, you could say. So look at this capitulation on the chart, on the oil daily chart. That is a really nasty just get me out type of trade. We have since bounced, which looks slightly technical, but China's factory order activities has contracted in April, not good. And as I say, from Sunday, their imports have actually fallen quite steeply, which means the economy is not as strong as they thought it may be. And then, you know, we've got on Monday, we saw US ISM manufacturing PMI still deep in contraction, so suggesting a recession. So global demand is still weak. In fact, I would go as far to say it looks like we've got almost a global manufacturing recession in place already. And I think, we've got all sorts of reports out showing demand for refined oil goods like gasoline, diesel, jet fuel, all been dropping. But this industrial production data we've had out of Europe in the last couple of days, plus this manufacturing slowdown in contraction, is a commodity issue. So I think we need to be careful whether this demand's going to come from now. I think the market, whoever's trading commodities, is certainly looking at sort of China data, manufacturing data around the world to see where we come. But it has to be said that, as Bloomberg has reported, speculators have cut long positions by 19% last week. That's that capitulation in oil you can see, but also in copper. We've seen hedge funds just dumping commodities because, their story changed, and, it's now about growth and, unfortunately, the lack of it at the moment. So I think a lot of those longs have seen capitulation, and that's the story at the moment. It's about growth. I do feel that later in the year, some of the supply issues could return, where there's going to be a shortage of copper and oil. And it's very unlikely, with oil prices where they are, there's going to be a lot of investment going in for new oil. And so realistically, at the latter part of the year, we could see a bit more demand balancing out against a tighter supply, if you like. So it's all it's not all bad news for copper and oil. I don't want to be the bringer or Dr. Doom, if you like, but a Fed pause and robust US employment data helped to keep copper and oil prices supported over the last few days. So the market has decided that the Fed is probably going to pause now. And if we look at the inflation data we saw today, I would suggest there's enough in there to suggest we may be pausing now rather than hiking in July. But the Fed increased rates 1/4 point again, but did signal a potential end. And so I would have expected the dollar to come off a little bit. That should actually help copper and oil, because also it may mean that the pressure on the economy with ever higher rates is possibly going to ease. And so we might get a bit of demand come back through. But I think a lot of this bounce that we've seen, as you can see on the hourly charts on the right-hand side of this slide, are slightly more technical. But I do think the Fed pausing is possibly going to help. And remember that the dollar does play quite a huge role in dollar-based commodities, as you would expect. But the big moves are really coming from either the supply issues or the lack of demand. That's what we're seeing at the moment. So as you can see on Friday, the 5th of May chart on the bottom left here, solid jobs growth again from the US. I have to say, it's to me, it's going to be difficult for them to justify cutting rates at any time unless this unemployment data starts to rise. And we're not seeing that yet. So a pause maybe, that may lift the commodities a little bit, just on a dollar basis. And the hope is that demand will come back. The only thing I would suggest about hope is very rarely a good strategy. So I think at the moment the market's sort of stuck here a bit, but I think that, not all commodities are in the same boat. But what we are seeing is the bad news is actually quite good for gold. Gold and silver have done quite well. Look at this chart from the 1st of March. We've had a very strong rally up towards the recent all-time highs. This is a fear factor issue. Gold is doing well because of systemic risk. So as the banking systems are having a credit issue, then we're seeing gold rise. On this chart on the right here, you can see this plunge in regional banking stocks, and apparently there's a bit of that going on again today. And gold has actually outperformed just about everything, equities, all other commodities as well. So gold sometimes plays on its own, and it's very much a risk-sensitive structure. So, we've got the debt ceiling standoff, we've got potential global US or global recession, and this regional banking crisis. The ripple effects of that are still spreading out. And so gold is actually doing much better than many people expected. And that's because it's in its environment that it breeds best in. And at the moment, that is risk at the moment. And when risk is off, gold is doing slightly better. So, the daily chart from the 1st of March shows all this. Gold traders need to be wary of better economic data, though, because as soon as we start getting some good news, these gold longs are going to start, I think, exiting. So be careful of good news for gold and be careful of bad news for everything else in the commodities. A bit mixed, but gold is a completely different animal. Something worth knowing as we go forwards. Well, that's it for me. I'll be back in next month. I hope you have some good trading between now and then. Very interesting markets indeed. And I'm going to sort of end there and see you in a few weeks.